What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind the trade entry, trade management, and the closing order. In this video, we are going to cover the crab trade. Let's get into it. Today, I placed a trade in Nike. Here's my thought process. Nike has a low implied volatility rank of sitting around 11%, which means that it's got low implied volatility relative to itself over the last year. It currently trades at a 90 price tag, which is relatively low considering that it has been as high as 124 in the last year or so. If you want to lean a little bit long, which is my assumption here, I went with a poor man's covered call, crab trade, butterfly, a funky, spicy little spread here. So I went out into June, and in a poor man's covered call, we typically buy a long call option that is our synthetic stock position. I'm buying the one of the 85 strike calls. This is your stock position. In the May monthly expiration, I went and sold some premium. So I sold two of the 95 strike calls. This is your short call type position to your synthetic covered call. For me, to reduce the capital requirement, you could see it uses about $2,000 in buying power. I went out and bought the 105 strike call just to define the risk. This significantly reduces the overall risk of the position. It reduces how much capital you're using on the position and makes it a risk-defined position using $540 of total buying power. When we flip to the curve analysis mode, we can see that our risk profile mirrors that of a butterfly, but with a little bit of added upside potential. The 185 strike long call is a more static delta, while we have some decaying short premium at the 95 strike. This position benefits from a sideways / up move. Our ideal situation would be a move right to our short strikes at 95, where we'd potentially receive our max profit. On this sort of trade, you've got about a $500 max profit. I will be targeting around $100 to $150 in profit for my closing order. All right, so we are back with our Nike position. If you remember, we put this on a couple weeks ago. About 19 days we've been in this trade. We were targeting somewhere around $100 in profit. It's actually come in quite nicely over the last couple trading sessions. This is a bullish position, and you could see we put this on around 19 days ago, so early in April. You could see we kind of hit a bottom here in Nike. It has since rallied up, which is exactly what we wanted. Some time has passed. That is also exactly what we wanted. You get that theta decay, a little bit of a vol contraction. You can see IV rank here at 14, so we know that volatility has come in a bit as well since we put this trade on. And so, you've got kind of the combination of price movement, volatility change, and time coming out of that position, which allows us to now manage this as a winning trade. So from the trade page, the way we could close this out is a number of different ways. So we can do this as an opposite order from the right side menu. So you right click and go to opposite order. This will route the opposite to your opening trade. You could do this from the activity page as well here, or you could do it manually from the trade page. So from the trade page, you would be going to sell out of the 85 call that we are long in June. In May, we would go and we would buy back the two 95 calls that we have at the money here. And then we would go to sell out of the one contract 105. You can see this trades at a mid price around 643. We open the trade at a 536 debit. And so we've got about $107 of profit on the table here for this position. So when we route the order, the mid price is a good spot to start the order at. It's not a automatic fill, right? It's the middle price between the bid and the ask for each option that you are trading. So here, this bid-ask spread is 3 cents wide. You could see you've got 3 cent wide on the 95 strike, and then 10 or 15 cent wide bid-ask spread on the 85 strike, which leads to this bid-ask spread at the bottom. You'll typically get filled somewhere between these two prices, which is perfect for this trade. If we don't get filled, You can always cancel and replace the order, adjust the price a little bit. You usually have to go down if you are selling to close, up if you are buying to close in terms of the price. So we're going to route it at the mid price here of 641 and see if we get filled. You can see all the metrics of the trade. This will clear up a little bit of buying power as well. And there's our fill, 641. Comment below on what strategy you'd like me to cover next. If you want to catch these trades live, tune in to Johnny Trades every Thursday at 9:40 a.m. on Tasty Live.